Good evening, everyone. Welcome to the weekly position management webinar. This is for our Platinum Trade Alert service. Allison is with me tonight. Scott is traveling. So what we're going to talk about tonight is technical charting and some of the technical indicators that we use on charting. We spend most of these webinars talking about strategies, management, adjustments, trying to really refine the position itself and protect the portfolio. That's a great amount of the emphasis that we put on these webinars. But one very important part of being successful on a consistent basis is how accurate you are in being able to interpret the directional bias of a chart. So we're talking about stocks, we're talking about indexes. What Allison and I are going to do tonight is start with the NASDAQ 100 index. We'll see how much time we spend on this. We may look at the S&P 500, but I'm going to use these two indexes as a way to hopefully get you to think a little bit more deeply about the importance of technical charting. So let's go ahead and get started. I'm going to show my screen here. Allison, can you see that okay?
Yes.
Okay. All right. Perfect. So I'm going to start with just a basic chart. Now, what I ask you to think about as you're looking at the charts is how you would interpret the pattern and how you would identify what the near-term versus long-term directional bias could be. It's important for us to identify what the particular direction could be. And I really want to just qualify everything I'm saying tonight, that there are no guarantees of anything. There are no absolutes. There are no certainties of anything. But there are ways that we can monitor our charts and increase the likelihood that we are accurate in terms of the overall directional assessment that we make. Why that's important is because that directional assessment is going to, A, lead us into selecting a new position, and it may guide us to a particular strategy. And B, if we're evaluating an existing position, our evaluation of the chart is most likely going to have some weight in guiding us to whether or not we should close the position and take a profit, even though there could potentially be a greater profit if we just look at the dynamics of the position, or do we need to take some sort of management action? What I find comfort with from the charts is the charts tell me whether or not I can afford to be patient and wait for something to occur, or whether or not we're starting to get into trouble and we need to take some sort of management or adjustment action in order to either protect the position or to just absolutely protect the portfolio. Excuse me. So we're going to start with just a basic NDX chart. Now, those of you who have been through our Trade to Win program or through our one-on-one coaching, some of this will be redundant for you. It'll be a replay, but I think it's really important to go back and revisit some of the details on your chart. I'm not going to give you a detail chart instruction as though you're a beginner and you haven't done this before. What I really want to do is to give you some fine-tuning points and some triggers that I believe are key to you being able to play the market more successfully. So the NASDAQ 100, as you already probably know, because we profile this a lot, is one of my favorite indexes to trade. And the first thing that is important in your charting is to identify multiple patterns. I like to have multiple patterns that give me clues so that if I have 3 patterns on my chart and I'm not sure which one is most valid, those three patterns are going to stay on my chart until one of them proves itself. And proving itself means that the price is going to move higher or lower, break outside of one of the patterns, validating one of the three patterns more so than the other two patterns. We had a good example of that today where we were talking on the call this morning on our daily alert call about the short-term pattern. Now, let me just jump to the 10-day, 10-minute chart for this. This morning on the daily call, we were talking about this sideways trending channel on the NDX. This sideways trending channel started on the 12th, started on Monday, and it started after we saw a fairly sizable OOPS pattern at the open. We validated the support level of this channel, and we validated resistance when we moved up and touched it. I think we had three different 10-minute bars that touched a resistance and confirmed that level of resistance. So that's our sideways trending pattern. At the same time, we had a declining pattern, and this morning we talked about this wedge. So let me extend this out, and I'm going to talk about this zone that's formed between the resistance of the declining pattern and support of the sideways pattern. Now, I would almost always default to saying that the longer-term pattern has dominance. The longer a pattern has been in place, the greater the likelihood that it has integrity, which means that I tend to believe that pattern more than other patterns. But that's not an absolute. It doesn't always hold true, and today was one of those cases. Okay, hold on just a second. So here we had a declining cycle, and you can see running along that resistance, we had multiple price points that continued to validate that declining resistance. We saw a series of lower highs, basically. But when you see a series of lower highs, in order to confirm that you have a declining pattern, you want to see a series of lower lows. And here we had a low, and then we had a lower low, but then after that, this morning, we flattened out right at support of that sideways trending pattern. So now we have a dilemma. And as traders, Scott and Allison and I are looking for clues that give us kind of a open highway in one direction or the other, because then we can trade all day long that direction. When we see a pattern where the lows are validating support of one pattern and the high price points are validating resistance of another pattern, it forms this wedge. The intersection of resistance and support forms this V, this wedge in here. And as the price gets buried into that wedge further and further, we know with absolute certainty it's going to break one way or the other. The price is either going to break higher above resistance or the price is going to break lower below support. Now, we said on the call that we weren't sure which way it's going to break. I'm going to put on some other technical indicators here in just a minute. We had some clues. We felt that there was probably a stronger bias to the downside than there was to the upside, but there was no certainty of that, no absolute certainty. So what we decided this morning relative to some positions that we hold is we used the chart to tell us today was a day to put everything on pause, meaning we're not taking any action today. We weren't in a place to exit profitably the positions we were evaluating on NDX, and so we needed to evaluate whether or not it was time for us to take any kind of management action. Well, management action would not have been appropriate yet because we don't know which direction it's going to break, and so therefore we didn't know what type of management action we would want to take. If it was going to break to the upside relative to our vertical spread, we might want to do a rollout or reposition. If it was going to break to the downside, we're not going to do anything. On our calendar spread, our 3600 calendar spread, if it was going to break to the upside, we would be evaluating time value remaining in the short leg, and we'd be evaluating how far it moved higher. And did it meet a line of resistance? Did it press through that? And did it challenge our next line of resistance? Yet if it moved lower, we would want to wait for an opportunity to exit. So we were kind of in a wait and see position this morning. But the advantage to tracking more than one pattern on the chart, like what we have here, is that when it does break higher or lower, you already have some clue as to where it could possibly move to. We treat the NDX as though it's got some stability in terms of its movements. The NDX has a tendency to trade in a range. Once it's defined that range, it does tend to trade inside that range for a while. And so when we looked at this sideways trending pattern, we anticipated that if it broke below support, we already knew about where it would come to. If it broke above resistance, the next line of resistance on our sideways moving pattern was actually up around the 3 standard deviation Bollinger Band. But we had some range of movement that we could anticipate. And so if it had broken to the upside, it very likely could move up to around 36.26. Having that information and that view that it could potentially move there and meet the next line of resistance helps us start to anticipate what we could potentially do with our 36.25, 36.30 position, helps us decide in advance what we could potentially do with our 3600 calendar spread. We don't have to take any kind of action yet, but it helps us start to think about the parameters of some sort of adjustment or management. We knew that if it had broken to the downside, that it was going to meet some sort of support somewhere around 35.90. And we knew that if it got down to around 35.90, we may have an opportunity to close our downward directional bias trades, or it would give us, if we weren't comfortable with the profit level, or if it wasn't profitable yet, a movement down confirming this declining channel as opposed to the sideways channel would give us the peace of mind to sit tight and hold the position for a while longer. Now, right towards the end of the day, Allison and I had a conversation about our 36.25, 36.30 vertical NDX spread. That is a spread that expires this week. And because we are breaking to the downside, we did get confirmation of a break below support, and because we did get confirmation of support being at the line of support of our declining pattern, I personally felt comfortable holding the position overnight. Now tomorrow we will absolutely be out of the position because NDX options cease trading tomorrow and are settled Friday morning. Now, I made that decision knowing that we could absolutely see NDX pop higher tomorrow. It could pop right back up into this sideways trending pattern. It could pop up to the 2 standard deviation Bollinger Band, which would be 36.19. It could pop all the way up to the 3 standard deviation Bollinger Band, which would be 36.27. If it went all the way up to the 3 standard deviation Bollinger Band in the morning, it would be highly unlikely that it would sustain that price level for very long. That's our experience with 3 standard deviation Bollinger Bands. If it came up to the 2 standard deviation Bollinger Band, which is not at all unusual with the rolling cycle pattern of NDX, well, with tomorrow really being the last trading day of the position and the 2 standard deviation being at 36.19, although it would be close, our position would still be out of the money. The only value it would have would be time value, and so it would still work out for us. So this was a decision that I made today, and Allison was right to make sure she pointed out that that position could be closed. I think, Allison, we probably could have closed it for about a 70-cent debit today, and our credit was originally $1.40 on it. So a 70-cent profit on a position that we've held for, I think, just 3 or 4 days is really an excellent return. But the chart empowers us to possibly take a greater profit when it makes sense. I'm a huge fan in taking profits in the 10 to 20% range, but I'm a bigger fan of when the chart gives us some clues that it may be okay to hold on to that position for another day, that we can do that and possibly end up with a bigger return. Now, I recognize that this thing could pop up more than that tomorrow. It could pop all the way up to the 3 standard deviation. We'll just have to play it out and see what happens. But I wanted you to understand how the chart played into my decision to hold on to that position as opposed to going ahead and closing it out and taking profits. For the sake of one additional day, it could mean the difference between a 70%, not 70%, sorry, a 70-cent profit versus $1.40 of profit. Now, the reality is we'll probably end up somewhere in between. I probably, unless there's some big fallout in the morning, I probably still wouldn't carry it all the way through to the end of the day. I might if the NDX just kind of drops off 30 or 40 points. But that is the, sorry about that, that is the chart evaluation and the factors that I considered on the chart to make a decision to either hold a position or close it out for profit. And being in the position where we had a profit gives us the luxury of evaluating the chart and making a decision about whether or not we want to just go ahead and lock it in, which is always a great decision. You can never go wrong locking in profits. Those are the profits nobody can ever take away from you. But sometimes there are opportunities to increase your profit. This, in my opinion, and I'd really be interested in your opinion about this, Allison, but this is not about rolling the dice and hoping everything's going to be okay, you know, squinting, closing your eyes, praying, whatever you need to do, hoping it's going to be okay. This was about doing a thoughtful evaluation of the chart, the channel lines, and the pattern, and making a decision based on that. So,
Right, exactly. And just to go off that, I mean, if you just, we're looking at very intraday charts in terms of 10-day, 10-minute with a lot of details. But if you just go back to the 1-year daily, we had a bearish divergent bar yesterday with a BB, a very small one, but a BB snap yesterday on the upper Bollinger Band. And we're coming down today, and we ended near the lows today. So I still think the likelihood, and we're trading near the top of resistance of a declining channel, so I think the likelihood of us coming down is still rather high. So holding on to that, knowing that we're trading still near the upper Bollinger Band and everything like that, I feel very comfortable with doing. So.
Yeah, Allison
That
makes a
was
very
why
good
I said
point.
that.
It's a ongoing assessment of different technical patterns that we see. Allison's pointing out the bearish divergent bar that we had yesterday, where we had a higher high than the previous day, and the close was in the bottom 50% of the day's range. That's a strong indication of a declining bias. We have patterns here where we've had a pattern in place, a declining pattern in place, since about the 10th of March, where we've seen a line of resistance that we have tested and validated more than one time. Okay, so back here, popped a little bit higher and came immediately down. We tested it here, came immediately down. We've gotten close here and came down. We got close, or we tested it and popped a little bit higher yesterday and then immediately came down. So all of these things actually point to why the charts are so important to us in making a decision on an individual position. It's not just about entry into the position. It's also about what would make the most sense. If I don't have a very clear sense of what's going on, I'm just going to take my profit and run. But if I have patterns like we see today, I may let that position linger out there as one of those few opportunities to take a little bit more profit off the table and put it in my bucket than we would normally see in our kind of everyday average trading. Allison also mentioned the Bollinger Band snap, and I'd like to, if you notice I don't have all the other technical indicators on here right now. I'll put them on in just a few minutes, but if I want to really highlight the Bollinger Band snap for you and give you a couple of things to think about. First of all, as a reminder, a Bollinger Band snap is where the price, the tick, some portion of the bar, the price bar, has moved either below the lower Bollinger Band or above the upper Bollinger Band. We find that there is a very high degree of likelihood that when that occurs, the price is going to snap back. And generally, we find that it's going to snap back in 1 to 5 bars. So 1 to 5 bars means if you're looking at a daily chart and you have a Bollinger Band snap on the daily chart, in 1 to 5 days you should expect a reasonable likelihood that it's going to snap back higher up inside the Bollinger Band envelope. If you have a Bollinger Band snap on the upper Bollinger Band, as we did back here on the 23rd of December, there's a high likelihood that you're going to see it snap back in 1 to 5 bars. Now, this is a great example of one where we saw a Bollinger Band snap, perhaps take a declining bias trade, and we're going to talk about strategy in just a minute, take a declining bias trade, and the minute you put that on, you might start getting nervous because the next day it went higher, day 3 it went higher, day 4 it went higher, day 5 you think you're starting to get back to where it should snap. Day 6, let's see here, I'm sorry, I lost track. 1, 2, 3. Day 4 it dropped. Day 5 it popped back up again, and here you are where it starts to come down. Now this one took a little bit longer than our usual experience of 1 to 5 bars, but still you ended up after a week with a really solid position and a solid profit. If you'd gotten in on this bar to a declining bias trade, the open of that day was 35.63. We count out our 6 days, and the low of that day was 35.12. So you're down 50 points in 6 days. It's ample for you to be able to take a profit. So if you're someone who is a fairly active trader, or I will tell you, if you have time for the first hour of the market every day to focus on the market, there are some huge opportunities with Bollinger Band snaps at the opening of the market. And there are a couple of ways that you can take advantage of these. One, we don't really teach and we don't alert positions on, and it's way more aggressive than the other strategies we teach, but it's a pure momentum trade. If I saw this occur, I just buy a long put. If I saw us decline below the 2 standard deviation Bollinger Band, lower Bollinger Band, I'd buy a long call. Now, I'm not going to talk about that strategy, in terms of the dynamics of it too much. It's a very risky strategy. So just proceed with extreme caution if you do those types of trades. But there's also no reason for you to have to take an extreme position, meaning that much risk in order to take advantage of a Bollinger Band snap. You can trade a call vertical spread or a put vertical spread, and you can place it right at the money. If you have a high degree of likelihood that it's going to snap back, and you know that that average snap is 1 to 5 days, and you follow the rules that we set out about leaving yourself enough time for the position, I might open a vertical spread when I see the Bollinger Band snap here, and I might place this trade out 2 to 3 weeks. I might open an at-the-money vertical spread, which is going to give me a big credit, as much as 50% of the spread itself as credit. So maybe $2.50 of credit on a $5 strike spread, or a $5 credit on a $10 strike spread. I'm going to place that at the money, but I'm going to put the expiration out 2 to 3 weeks. And that's giving me enough time, based on my experience with Bollinger Band snaps, to allow the market to cycle back down. Even if it moves against you first, you're just going to be patient, and you're going to wait, and you're going to wait for it to come down, giving you an opportunity to close out of that trade for an overall profit. So vertical spreads are an excellent strategy to use when trading Bollinger Band snaps. And the other favorite strategy I have for trading Bollinger Band snaps would be a calendar spread. Now, I talked about calendar spreads here recently, and you see us alert calendar spreads on a pretty regular basis through the alert service. I will say, I don't know how many of you go to the website and look at our trade alert performance and look at the history and everything, but I will say the calendar spreads, of all of the spread strategies we trade, the calendar spreads have the most consistent, highest percentage of wins to losses. We're right now running about 90% wins to losses on our calendar spreads, and our average win is 11.2%, and our average time in trade is 4 days. So you have a strategy that is designed to take advantage of these types of movements, and it's designed to allow you to get in and get out rather quickly. Now, you can do these types of trades on other equities. Scott Allison and I have a tendency to stay away from most of the stocks when it comes to these type of Bollinger Band snap trades. Stocks just perform differently than indexes. A stock could run up and have a 2 standard deviation Bollinger Band snap. It could have a 3 standard deviation Bollinger Band snap, and it could stay there for days. The 1 to 5 bar experience I'm talking about is really on the NDX and SPX. That's been our historical experience. So let me just kind of summarize that for you, and then I want to move on and talk about some other aspects of the technical evaluation. The chart is an extremely important aspect of your successful trading. If you want to look for opportunities for a rather quick trade and you have time at the beginning of the market, we find that there are frequently abrupt moves right at the open that push the price outside the 2 and sometimes outside the 3 standard deviation Bollinger Band. If you want to trade that, a vertical spread, call vertical spread if it's breaking the upper Bollinger Band, a put vertical spread if it's breaking the lower Bollinger Band, is one strategy to employ, or a calendar spread would be another strategy to employ. If you asked me which one of those two would I prefer, I would hands down prefer the calendar spread. The calendar spread is going to give you greater opportunity for profit. It's going to give you probably as quick of a profit as the vertical spread will. And it's a fairly forgiving spread strategy. The index can actually move against you, and you can still end up closing the spread overall for a profit. So that's kind of a summary of how to use the chart to evaluate a current position. And I was talking about a 3625, 3630 NDX vertical. Why we used the chart to make a decision to remain in the position a little bit longer, even though we had a 70-cent return, 14% return on our position. And how to use the chart if you used no other technical indicators, as you see my chart right now, and you just purely looked at Bollinger Band snaps as your trigger for opening calendar spreads or vertical spreads. Allison, any thoughts you want to add to that?
No, not that I can think of at the moment.
Mm-hmm. Okay. Let's get down to the, I'm going to emphasize one thing here with the Bollinger Band snaps. Most of the Bollinger Band snap trades that we trade are based on 10-minute or 60-minute charts. If we see a Bollinger Band snap on a 60-minute chart, we consider that to be a pretty strong clue. So here we have Bollinger Band snaps on the lower Bollinger Band. Here we had one on the lower Bollinger Band on the 60-minute, and then it was 1, 2, 3, 4, 5. It was the 6th bar that would have taken us out of that trade. Here we have a Bollinger Band snap on the upper, and it was the very next bar. Now remember, these are 1-hour bars, so this trade actually ended up being just a day trade. Okay, so you got to be careful about your day trades and make sure the size of your account can accommodate day trades if you decide to do these types of trades. So as you can see, not every single one of these Bollinger Band snaps ends up necessarily being a profitable trade. You might have gotten in on this bar. The next bar isn't enough for you to get out, and then it moved against you for a few days. But it was over here then that you could have gotten out of the trade. If the position is designed correctly and you've allowed enough time in the position, whether it be a calendar spread or a vertical spread, that still would have been a successful trade. You might have had a little anxiety during this period of time, but you just have to continue to monitor your charts and look at the patterns. Let me show you the primary view that most of you have learned, where we have our awesome oscillator, we have our MACD historical, we have our stochastics, we have our Bollinger Bands still, We have our 10-day and 30-day moving averages. We have breakout signals on MACD and stochastics. I get the question frequently, how do I know which time period to use? And the right answer is you use all of the time periods. I generally start with a 1-year daily, and my objective is to identify as many of the cycles as possible. Those are all these, not intraday, sorry, those are all these up and down movements, the sequence of up and down movements that basically extend from one to the next, okay? We went up, we went a little sideways, we went down, went small up here, down, up, down, up, down, up. I'm looking for all of those cycles. After I've identified all of those cycles, I identify where my channels are. And I am looking for support and resistance levels that will incorporate as many of those cycles as possible. So here you can see during this whole period of time I've got multiple short-term cycles that I've identified, and then longer term I have a long-term channel that incorporates all of those cycles. So the channel is identifying the parameters where each of the cycles ranges inside of. When you have both channels and cycles identified, it becomes a lot easier to recognize when we're shifting direction. So here on a 1-year chart for the last year, we saw a rising pattern. And all of the movement during this period of time took place inside the parameters of this rising channel. Now, this channel has a depth of 240 points. So there were days and weeks where the index was dropping as much as 240 points. Not in a single day, but over the course of weeks. There were other weeks where it was rising again from its low back up another 240 points. So there was movement down and there was movement up, and all of it took place in an overall rising pattern. When we got out here, we have that rising pattern extending, and it was when we formed our first point below that rising support that we started to question whether or not we were still in a rising pattern. It was when we formed our second point that we pretty much knew we were no longer in a rising pattern, and we were able to go back and identify a sequence of tops here, here, and here that showed us that we had some declining highs, and then we've continued to validate that. But all of this activity now is outside of that channel that contained everything for the past year. And that's why we think that it's highly likely that we've shifted gears and that we are forming some sort of a declining trend. Having this rising channel in place along with all of the different cycles allowed us to identify how far out this channel would project. It allowed us to also identify how far out this cycle would project and at what angle. And so we have some identification of which direction the index could possibly move when it hits this resistance level or it hits this support level. If I back up one step further, though, we are actually still in an overall rising pattern. The blue lines here are a 5.5-year pattern. And you can see here that we've basically, for the last 5 years, been in an overall rising pattern. Now, the depth of this channel is 720 points. that means that all of the activity in the last 5 years has taken place in rising and declining cycles, in rising and declining channels. Let me back up. Let me back up here to the 5-year. All of that movement has taken place inside the parameters of the 720-point range. And we've seen cycles and channels that have been declining. We've seen it followed by cycles and channels that have risen. We've seen it followed by sideways channels that contain rising and declining cycles, and so on and so forth. We've seen all of that movement for the last 5 years take place inside the parameters of this channel. So what we see here coming off of resistance of this channel should not surprise us. We should not be surprised to see that once we hit resistance of this rising channel, we should not be surprised to see some sort of trend lower. Staying on our 5-year chart, if I take this current declining channel we're in and I extend it out, I can have some sort of a clue, some sort of a forecast of where we could possibly trade to. So what if we did stay inside this channel, cycling up, cycling down, cycling up, cycling down? What if we stayed inside this channel and got out to September of this year? That means that if we were trading at support of the 5-year channel and support of our declining channel, September 1st, the NASDAQ 100 could be trading around 3,200. Okay, that's 393 points below where it's currently trading. I'm not saying that's going to happen. I'm saying that by having a well-defined set of parameters that we know the index is traded inside, you can project where it could possibly go to. And I just want you to recognize that we could trade down to 3,200, and based on the definition of this blue channel, this 5-year rising channel, the NDX would still be in an overall rising pattern. It could have been declining for the past 6 months by the time we got out to September. It could have been in a declining pattern for 6 months, and technically in the big picture view, we still would be in an overall rising pattern. Now, we like to have big picture view. We like to understand what's going on 5 years, 1 year. But when it comes right down to it, we make the majority of our trade decisions based on 60-minute and based on 60-minute charts with some confirmation coming from 10-minute charts. And I know Allison will sometimes look at a 5-minute for a little bit more clarity, and I frequently during the day will monitor a 2-minute to see a little bit more clarity for detail. So my bottom line in sharing this with you is by recognizing these patterns and devoting a certain amount of time and attention each day to your charts, which each of the three of us do, you start to find the clues that are going to give you trading opportunities. Now, do I want to be taking a trade when I'm in the middle of this declining pattern? I probably don't want to take a directional trade, but I might want to trade a market tamer, non-directional strategy. When I'm at the very top of a declining pattern and it also happens to be coinciding with resistance of another short-term pattern, so I've got multiple resistance levels, do I want to trade a market tamer there? Or would I rather trade a directional bias trade that will take advantage of a declining bias? I think I would be trading a call vertical spread there, or I would be trading a calendar spread. When it's trading at the bottom of the pattern, even though You might look in the rearview mirror and say, listen, this thing's been going down for 3 months. This thing is going to continue going down. I'm going to play it to the downside. Well, you might be disappointed at first, because if you play it to the downside when you're trading around support, based on the depth of the pattern and based on the history of movement between support and resistance, you might be disappointed to the tune of 236 points for the next few days or a few weeks, and that can hurt your trading. So part of the trick here is to use the charts so you don't get caught on a turn. You don't assume that it's going to break through support, so you take a downward bias trade. You don't assume that it's going to go above resistance, so you take a rising bias trade. You wait for the chart to validate that. So now let's come full circle all the way back to our 10-day, 10-minute chart on NDX. And I know I said I might take a look at SPX, but I wasn't sure how much time we would have to do that. So we come all the way back. Actually deleted my lines here, so let me put them back on. And you can see here today where, let's see, that's not what I wanted, sorry. You can see here today where we were tracking basically a sideways trending pattern coming across this whole series of lows that continued to validate our support. But at the same time, we were tracking our declining cycle. And so if we come all the way back to what we just talked about, we know that the declining cycle and the sideways channel were forming this type of a wedge. This is the no decision zone, in my opinion. This is where you don't jump too quickly to manage something. This is where you hope you've allowed plenty of time in your position, so you have the luxury of just relaxing and waiting for things to be proven to you. In my opinion, and we'll see what happens tomorrow, but towards the end of today's market day, we got validation that this declining channel may, in fact, have more integrity now than the original sideways channel that we were in. Because when we dropped through support, we came right down to support of this declining channel. So there's an awful lot to talk about with regards to charting. I'm going to add just 5 more minutes of the other technical indicators as clues, and then I want to take some questions if you have them. When we were evaluating this wedge today, we aren't looking at just the formation of the wedge. There's a lot of potential error in the way we draw charts, draw channel lines. Allison and I will frequently compare our charts, and she may have a little bit of a different tweak to her channels than I have. We compare notes, and generally we will get ourselves in sync. But it's good to have someone else's viewpoint.
Mm-hmm.
The other technical indicators help give you clues. So I may have said this morning, I don't remember. But when we talked about this wedge that we were burying ourselves into, and we didn't really know which way it was going to break, I think I said I have a bias towards the downside. And that's because if I look at the other technical indicators, I saw that we had the AO trading below the zero line. That's like weighting the price down. I saw that we had breakout signals to the downside on MACD, stochastics, and AO. Now, granted, I'm on a 2-minute chart, but now if I start to back up and validate everything that I'm talking about, here we go. We had dipped below the zero line on the AO. We had breakout signals to the downside. Yes, we had some conflicts, but after that set of 3 breakout signals on the 10-minute, we didn't have any conflicts after that, meaning we didn't have a set of 3 that would contradict it. We back up to the 60-day, and we saw the AO was becoming weaker and weaker. We had breakout signals to the downside. So there was nothing really on the other technical indicators that was saying, hey, listen, this thing's going to go up big time. Nothing telling us that. We know that could still happen. We know that these technical signals are not infallible, but there were no clues whatsoever. So the bottom line here is we're bearing ourselves into that V. We had no certainty, no 100% certainty which direction it was going to go. We saw a lot of indicators saying probably lower as opposed to higher. As it turned out, towards the end of the market day, that's exactly what happened. But that's how we put together our decisions. That's how we make our decisions. Those are the conversations that Scott Nelson and I are having throughout the day. And that's how we evaluate our existing positions and what action to take. Last comment, and then take questions. I'm a very strong believer that the chart allows you to make informed, reasonable, non-emotional decisions as opposed to, oh my God, this thing's going higher. I mean, our SPX position was in the money. Our vertical spread yesterday was in the money by a couple of points. What are we going to do about that? Don't we need to manage that? Don't we need to do something with it? We can take all the emotion out of the decision-making process. We can evaluate our chart, and we can make an assessment about whether or not we can afford to wait, which we could because we'd put time into that position. We can make an assessment about, well, is this just a small blip up? What indicators do we have that show it's going to continue or go lower? And we could afford to make the decision to wait one more day. If you notice, we do these calls every single day. We never make a decision that we're going to hold that position for another week. We only make a decision that we're going to hold it for another day. And we're going to come back at it again the next day, and we're going to evaluate it again, and we may make a different decision the next day. So let me see what kind of questions you have. Bob's asking, what about the AO on the weekly? We look at the AO on the weekly. Let me pull up 5-year weekly. The AO on the weekly is our best long-term gauge of where we're probably headed. It's not how we trade because it's like the ocean liner. It's going to take miles for you to turn that thing around. It just takes a long time. It's not our foundation for trading decisions, but I will tell you it gives us a greater degree of confidence when we can take a trade that is also in sync with what the long-term view is. And in this case, the long-term view based on the AO is we're going down. And it's been that way since the week of January 6th. That's really when we started to shift with a peak and then the next lower peak, and since then we've not formed a peak anywhere close to what we saw in terms of the size of momentum. So momentum has continued to decline quite significantly based on the weekly chart, and we see breakout signals to the downside. Everything on the weekly chart is still pointing to an overall declining bias, and yet for 5 years we've been running higher. We shouldn't be surprised that we ran higher for quite a while here during 2013 because we actually saw the AO continuing to show increasing momentum. So we use the AO as a long-term gauge of where the price is going, and right now it looks to me like the price has a strong bias to continue lower. Let's see here. Is the chart profit charts in Thinkorswim? Yes. I've used profit charts for as long as I've been charting. Profit Charts is the chart package that's available in Thinkorswim. If you don't have a Thinkorswim account, you can subscribe to it. I just simply subscribe to it. It's like $40 a month to pay for the package. But if you have access to Thinkorswim, you certainly can get it there for free. Our website is optionsmoneymaker.com. Most of you know that by now, but if you want to check out all of our historical performance, feel free to do so. You're going to start to see some changes in the website in the next few months. We're doing a complete revamp of the website, and so you should see a kind of a new look, a new face to it coming up here in the next few months. All right. What other types of questions do you have? Or Allison, do you have anything that would be really earth-shattering for everybody to pay attention to?
I don't know if earth-shattering necessarily, but just a little reminder. When you start to see yourself in a wedge or uncertainty like that, sometimes the best course of action when you can't get into a non-directional trade, like the iron condor doesn't give you enough premium, which was kind of our problem today, or anything like that, sometimes the best thing to do is just sit and hold tight. The market will eventually give you something to trade, and you never want to get yourself stuck into a position where you always feel like you need to be in a trade, try and enter something, and then it's not really that great of a trade and you're forced to manage it and put more capital into it. It's better sometimes just to hold, wait till the chart really gives you something, and then go back in again with a, good trade that you can win at.
Well, Allison, I do think that's earth-shattering because I think that's excellent, wise advice. You never want to force yourself into the trade because you've got available capital. I'd rather have you sit on the sidelines and wait until you see some good, strong clues as to which direction the market might be moving. Now, if you don't see good, strong clues, and you see lots of conflicting indicators, I'll tell you that the best strategy for you to trade might be a non-directional strategy like the market tamer. So you can be invested as often as you want to be, but be wise about how much capital you put into each trade, and be wise about the decisions you make, and rely heavily on your charts as opposed to your emotions. That's where you're going to win and be more successful. Well, that's about all we have time for tonight. Let's see if there are any other questions. Well, thank you, Bob. Bob's comment. Thanks, guys. Really learning a lot from all of you. Best service I ever subscribed to. I really appreciate that. Miles, very comprehensive review. Thank you very much. We appreciate that. Scott and Allison and I don't just trade. We pride ourselves in being able to provide a level of education so that each of you can be successful trading. We cannot guarantee your success, but what we can tell you is that we will give you as much as we can to help you stay on the right track. So that's it for tonight. I appreciate everybody being here. Have a great evening. I will have this recording archived probably tomorrow morning. So if you want to go back and play it again, feel free. Have a great evening. Talk to you later. Thanks, Allison, for being here.
All right. Thanks, everybody. Bye.
Bye-bye.